Hello, and welcome back to the channel, where we break down financial strategies to help you achieve your goals. Today, we're diving into a topic that sparks the imagination of many, but is often misunderstood: living on dividends. For countless people, the idea of earning enough passive income to cover all your expenses and live life on your terms feels like the ultimate dream. Passive income, in this context, isn't just a buzzword. It's a financial reality that can grant you the freedom to leave behind the daily grind, explore your passions, and spend more time with loved ones. But how realistic is it? Specifically, what is the absolute minimum amount of money you need to invest to make this dream come true? We're not just tossing out ballpark figures here. Instead, we're going to delve into the details. We'll explore the mechanics of dividend investing, break down the math, and consider the many variables that influence how much you really need. Whether you're starting from scratch or already on your way to building a dividend income stream, this video will give you the insights you need to make smarter decisions. Understanding this can be life-changing because knowing how much you need to save and invest can bring clarity to your financial journey. So grab a notebook, settle in, and get ready to learn how to turn the fantasy of living off dividends into a reality. What are dividends? Before we get into the calculations, let's make sure everyone is on the same page when it comes to dividends. Simply put, dividends are payments made by companies to their shareholders as a way of sharing profits. Think of it as a thank you from the company for investing in their stock. These payments are typically made quarterly, though some companies choose to pay them monthly or annually instead. They represent one of the most straightforward ways to generate passive income from investments. The beauty of dividends lies in their simplicity. You invest in a company, and as long as they generate profits and prioritize rewarding shareholders, you get a slice of the pie. Unlike other forms of passive income that require maintenance or active oversight, such as rental properties or side businesses, dividends often require minimal effort once you've built your portfolio. But there's a bit more nuance here. Not all companies pay dividends, and even among those that do, the amounts and reliability vary significantly. Some companies prioritize growth over paying dividends, choosing instead to reinvest profits back into their operations. These are often younger or more innovative companies looking to expand rapidly. On the other hand, there are companies like utilities, consumer staples, and established blue-chip corporations known for paying steady dividends year after year. Understanding this distinction is crucial because the type of companies you invest in will directly impact how much income you can expect. To successfully live off dividends, you need to strike the right balance between stability and growth. This balance ensures your income remains consistent while your investments grow over time. Understanding dividend yield. Dividend yield is a key metric when it comes to estimating how much you'll need to invest to live on dividends. It's essentially the return on investment you'll receive in the form of dividends. Calculating it is simple. Dividend yield % equals annual dividend per share/share price. 100, for example. If you buy a stock priced at $100 that pays an annual dividend of $4, the dividend yield would be 4%. This percentage helps you understand how efficiently your money is working for you. A higher yield means more income relative to the amount you've invested. Now, here's where things get interesting. The average dividend yield for reliable blue-chip companies typically falls in the range of 2 to 4%. These companies are often considered safe bets because they've stood the test of time and have predictable earnings. However, there are options to find higher yields, especially in specialized sectors. For instance, real estate investment trusts, REITs, and business development companies, BDCs, often offer yields as high as 6 to 10%. These investments can supercharge your income potential, but they come with their own risks. For example, they may be more sensitive to economic downturns or interest rate changes. Chasing high yields can be tempting, but it's important to remember that sustainability matters more than the headline number. A stock with a 10% yield won't do you much good if the company slashes its dividend next year. Striking a balance between yield and reliability is critical for building a dependable income stream. This approach ensures that your portfolio can withstand economic shifts while consistently delivering returns. How much do you need to live off dividends? The million-dollar question, or perhaps the million-dollar plus question, is how much capital you need to generate enough dividend income to cover your living expenses. The answer depends on several factors, but let's break it down step by step. This calculation isn't just about math. It's about aligning your investments with your personal lifestyle and long-term goals. Step 1. Define your annual expenses. First, calculate how much money you need each year to maintain your desired lifestyle. This includes everything: housing, utilities, food, transportation, healthcare, and entertainment. Be honest with yourself about your financial needs and goals. Are you aiming for a modest lifestyle, or do you envision extensive travel and luxury? For example, let's say you require $40,000 per year to cover all your expenses. This number is your baseline and represents the minimum annual income your dividend portfolio needs to generate. Step 2. Determine a realistic dividend yield. Next, decide on a realistic dividend yield for your portfolio. As mentioned earlier, blue-chip stocks typically offer yields in the range of 2 to 4%, while royalties, high-dividend ETFs, or certain niche investments can offer high yields. For the sake of this calculation, let's assume an average yield of 4%, which is both attainable and sustainable without exposing yourself to excessive risk. Step 3. Perform the calculation. To calculate the total amount of money you need invested, use this formula. Investment needed equals annual expenses / dividend yield. For instance, if you need $40,000 per year and your portfolio's average yield is 4%, the calculation would be $40,000 / 0.04 equals $1 million. That means you would need to invest $1 million in a diversified portfolio with an average dividend yield of 4% to generate $40,000 annually in passive income. Now, let's explore scenarios where you aim for higher or lower yields. If you're able to build a portfolio with an average yield of 6%, you would only need $666,667 to achieve the same $40,000 annual income. Conversely, if your yield is closer to 3%, you would need $1,333,333. This demonstrates why dividend yield is such a crucial factor in your strategy. The role of taxes. One often overlooked aspect of living on dividends is taxation. Depending on your location and the type of account holding your investments, dividends may be taxed at different rates. In the US, for example, qualified dividends are taxed at a lower rate than ordinary income, either 0%, 15%, or 20%, depending on your income bracket. However, non-qualified dividends, such as those from REITs or certain foreign stocks, may be taxed as regular income, which could significantly impact your take-home earnings. To minimize taxes, you can utilize tax-advantaged accounts like IRAs or 401(k) in the US or similar structures in other countries. These accounts allow your investments to grow tax-free or tax-deferred, which can make a massive difference over the long term. Additionally, some countries have tax treaties that reduce or eliminate withholding taxes on foreign dividends. It's essential to research the tax implications in your specific situation and incorporate them into your plan. Taxes might seem like a tedious topic, but ignoring them can derail even the best financial strategies. A seemingly solid portfolio yielding 5% might feel much less impressive once taxes chip away at 20 to 30% of your income. So, always consider the after-tax yield of your investments when planning for dividend-based living.